All right, it is that time of year again, report card season. But not for students. No, this is for India's 50 biggest companies. So who passed with flying colors? And who? Well, needs to hit the books. We're about to grade corporate India's performance for the first quarter. Let's dive right in.
Okay, so first, let's just make sure we're all on the same page. What even are these quarterly results? Think of them as a company's financial health checkup, something they do every 3 months. They lay out the revenue, the costs, and of course the profits. It gives investors a really clear picture of how things are going, and maybe a little hint of what's to come.
So that's the big question for today, right? How did corporate India actually score on its Q1 report card? Did they ace the test, or did the results kind of fall flat? Let's find out.
Now, before we hand out any grades, you got to look at the environment, right? The classroom conditions. And this quarter was really a tale of two different stories. Here at home in India, things were pretty steady. The economy was chugging along, inflation was starting to cool down. But if you looked outside at the global picture, things were a lot more cautious, a lot more uncertain.
And yet, despite all that global caution, the Indian market was clearly feeling optimistic. The Nifty 50 shot up 8.5% in the first quarter alone. So you could definitely say that investor expectations were running pretty high.
Okay, so you've got the market all fired up, expectations are through the roof, and that sets the stage for a classic showdown, right? Expectations versus reality. What did the experts think would happen versus what actually happened? This is where it gets interesting.
And boom, right out of the gate, our first big surprise of the quarter. See, analysts were predicting a pretty tame, maybe 5% profit growth. But the reality? Nifty 50 companies actually delivered 7.5% growth. That's a really pleasant beat. It's kind of like getting a solid B+ when everyone thought you were going to scrape by with a C. But hold on, this growth wasn't spread out evenly at all. It was a team effort, sure, but a few star players did almost all of the heavy lifting. Get this, just 5 sectors, we're talking banking and financials, tech, oil and gas, cement, and utilities, they were responsible for a whopping 71% of that entire profit increase. So let's zoom in on that sector scorecard, shall we? Because when just a handful of sectors are pulling the average way up like that, you know what it means. You're going to have some really big winners and, of course, some pretty clear laggards.
So, who was the star student of the quarter? The sector that just absolutely crushed its exam.
And the award goes to the cement sector. Wow. A massive 47% surge in profits compared to last year. That brilliant performance was really fueled by 2 things. They were able to hike their prices, and demand from infrastructure and real estate was just through the roof.
But for every A+ student, there's always someone who, struggled a bit. So which sector found this quarter to be a particularly tough test?
And that would be the auto sector, which actually saw its profits decline by 10%. They got hit hard on 2 fronts, really. Demand was weak, especially in rural areas, and at the same time, the price competition between all the car makers was just brutal, which really squeezed their margins.
Now here's a really interesting subplot that was happening just under the surface. It turns out the real star performers weren't the giants, but the mid-sized companies. These mid-caps grew their earnings by an impressive 12%, which totally outshined the large caps and left the small caps way behind. And this isn't a one-off thing. It's the 3rd quarter in a row they've pulled this off, so you can bet the brokerages are taking some serious notice.
So what we have is a better-than-expected quarter, but it's complicated. There's a lot going on under the hood. And all of this has sparked a fascinating debate among the experts. Is this the start of a brand new growth cycle? Or are there still some major risks just ahead?
In the bullish corner, you've got analysts like Varun Goyal of Mirae Asset. He believes that supportive things, like potential interest rate cuts, are going to fuel a strong recovery. In his own words, this growth cycle has much longer legs. He thinks this is just getting started.
But on the other side of the ring, you've got the more cautious view from someone like Sanjeev Prasad of Kotak. He's basically saying hold your horses. He warns not to expect green shoots of growth just yet, pointing to some bigger fundamental issues like weak consumer demand and a lack of good job creation that could really hold back a true recovery.
And here's how those different opinions actually translate into action. When you see overweight, that just means they're bullish on it. Underweight means they're cautious. And look at the stark contrast here. Motilal Oswal is betting big on financials, but MK is avoiding them entirely. Meanwhile, MK is bullish on tech and materials, which are sectors others are more hesitant about. It's a real strategic face-off, and it just shows there's absolutely no consensus on where to invest right now.
Okay, so we've graded the past, but what does this all mean for the future?
What should we be watching for on the road ahead for the rest of this year?
Well, the crucial number to watch is the full-year forecast for earnings per share. That's basically how much profit is expected per share for the whole index. And you can see that split opinion right here. While the forecasts differ a little bit, and some have even trimmed their estimates, the general consensus is still that earnings are going to keep improving from here.
Ultimately, the path forward really looks like a giant tug-of-war. Pulling the market up, you've got the tailwinds, like supportive government policy and the hope of interest rate cuts. But pulling it down, you've got some serious headwinds. Things like weak consumer spending, muted demand for IT, and, let's be honest, the simple fact that the market is already priced for perfection.
Which brings us to our final, critical question. The market is already trading near all-time highs, which means a lot of good news is already baked into the price. So will this earnings performance be enough to fuel the next rally and push things even higher? Or, with all those headwinds circling, is a big reality check waiting just around the corner? That is the question every single investor is asking right now. Thanks for joining us on The Explainer.